of the Federal Reserve system today. Was this in the textbooks where we are right now? Is it original monetary policy?
Oh, by far. The general notion has always been that when you create high-powered money, which is the reserves of the banking system, that it's just within a relatively short period of time that those monies are re-lent out to, in the United States, for example, J.P. Morgan has got a very large balance with the Federal Reserve Bank of New York. Very little of it has to date been lent out to IBM or General Motors or anybody else. And so long as that money's remain within the Federal Reserve System, it has no direct economic impact in the sense that, to be sure, it has a psychological effect on interest rates and a variety of other things, but the cash flows are not credibly involved and will not be until that changes. And there's some evidence that it might be changing now.
It might be changing now, but every real estate interview I do sums up they can't get a mortgage, either because of credit quality or because of income or uncertainty on the part of banks. Do we need a public policy to jumpstart the credit availability to housing?
Well, it depends what you think policy needs. Housing right at this stage, as you know, is moving nowhere. I mean, prices have been, even eliminating the so-called distress sales, which sell very significantly below the average, have been flat, and they've been flat for quite a while. It's very easy to demonstrate that unless and until we get prices up by at least 5 or 10% and hopefully more, you don't create enough equity in the marketplace to galvanize the mortgage market.
Now let's bring up the first chart that we've got here. And folks, this is the Fed funds target rate that we don't speak about anymore. Chairman, you can see it down here, the persistency of this zero bound. So many of our viewers worldwide hear this jargon. We're at the zero bound, and we talk about Orphanides' toolbox, and we talk about quantitative this and liquidity this. The fact is, in these unusual times, what would be the harm of any given central bank in raising rates a little bit? You had this battle in 1994. Should you go up 25 basis points? Should you go up 50 basis points? What would happen the next day now if any given central bank became not hawkish, but just began to tend towards neutral?
Well, it wouldn't be any central bank, but if it's the Federal Reserve, the ECB, or the Bank of England, for example, in any significant way, it's irrelevant what the order of magnitude of the change is. But what markets will respond to is that when you change policy, specifically in the United States, we've essentially committed out through the end of 2014, were we to change policy, even by 25 basis points, the markets would see it as a very significant change in direction, and as a result would begin to very heavily discount future federal funds rates. And remember, the federal funds rate is now no longer the effective price.
What is the effective price?
The effective price is what level of interest rates the Federal Reserve banks must offer in order to hold their excess reserve deposits in the system.
Right.
And so that it is the market which will be determining in the future what the actual rate is that is required, because it's competing monies of a whole variety of different instruments. The federal funds rate will arbitrage against that rate, and even though the federal funds rate may very well be the official rate, it's not the actual initiator.
Well, let's look at the rate that matters. Bring up this elegant chart. We've shown this, folks. I call this the chart of the quarter as the ECB caught up with our Fed. There's the balance sheet of the Fed with an abrupt move in 08, and then you can see the ECB catching up in the white line rather rapidly. When will we see our balance sheets of our central banks return to normal?
Well, right now, it's actually relatively easy to return to normal.
You are optimistic, as is President Dudley, that we can get back to normal?
Well, no. I mean, it's very difficult. I mean, technically, it is very easy because right now, I can envisage a structure right off balance sheet, so to speak. I mean, off market, where the Treasury and the Federal Reserve could get together, and the Treasury, for example. I'm not suggesting this is going to happen, but I just want to give you what the technical problems are. The Treasury can right now offer, say, 3-day Treasury bills for deposits at the individual Federal Reserve banks, which is essentially now almost all excess reserves. The individual banks don't really care whether they're holding U.S. Treasury bills but the Federal Reserve then has under its, I mean, it could be $500 billion, it could be $1 trillion of holding of reserves, which it could then swap for long-term Treasury debt.
You know what we've done together? I think we've just lost 3/4 of our audience on the minutiae.
Well,
let's come back.
Well, let me put it this way. That's the reason why this is such a technically difficult problem.
It is and very tough for Americans to grasp.
Let me go to the bottom line of this.
Please, the bottom line quickly.
The bottom line basically is it is technically very easy to do it, but the psychological impact on markets of the Fed doing, or the Treasury doing what I'm suggesting, is a very abrupt and very disorderly potential move, and therefore they have to be very careful.
Well, let's come back. The fiscal cliff that's coming up. Is any central bank, the Bank of England, the ECB, the Bank of Japan, are these institutions just exhausted because they've been asked to do too much?
They've certainly been asked to do too much, and they have done too much. The problem which is probably general around the world, is that central banks are moving into fiscal policy because they're being politically forced to do so. I think this is a very undesirable trend, and we should try to keep central banks to do monetary policy and let fiscal policy be done by elected officials. You don't want unelected officials, which is what central bankers are, to be involved in policy choices which affects the community as a whole. And this is what's wrong with currently going on. It is very difficult to have a dividing line between what is fiscal policy and what is monetary policy these days.
Is a central bank a reactive institution? Can they get out in front? You really had a challenge in '94 with this, didn't you?
Yeah, it's very difficult to do. And the reason why it is difficult is that if you move off the consensus and are wrong, you get pilloried. If you move off the consensus, or if you stay with the consensus and are wrong, it is not a big deal. And so central banks always take political risks to their independence, essentially, when they endeavor to go ahead of the curve. Because by definition, being ahead of the curve means you're in the minority. And being in the minority for a central bank institution is to make themselves politically vulnerable.
The age of turbulence. Can't say enough about this. Very readable and very interesting for those younger about the early years of his economic work. Alan Greenspan with us. Do you have a growth forecast? Do you do forecasting as you did years ago now? And do you have a forecast for the economy in the next 12 months?
Oh, yeah. In other words, I have the same type of econometric models that everyone has, but I'm now in the process of writing a book in which I'm trying to explain that what we are missing in all of our models and the reasons why everybody failed to forecast the crash in 2008 is, while we do well in understanding the non-financial sector of the economy, we do extremely poorly in the financial sector because our models are far too simplistic. And I hate to use the term, but I'm becoming a behavioralist the more I look at the structure.
This is a break exclusive right now, very much so. Bob Schiller just fell off his chair at Yale.
Well, the reason is that I had originally thought, as many had, that what Keynes called animal spirits was random and unforecastable. But having now looked at it in some detail and breaking it down, it turns out that when you take a look at the systematic way human beings behave, not rationally, but they behave, for example, the same response to fear and to euphoria. It's the same repetitive type of behavior, and that can be modeled.
So if you go out to the Chicago school right now, and Professor Lucas is in the front row, is he going to throw something at you?
Well, I can duck, but the question is not whether I have an opinion, but whether or not the econometrics, which he'll obviously like to look at, work. In other words, this is not an opinion. I'm being forced to move in this direction by the data. And if you don't let the data drive where you're going, you will never be a successful forecaster.
If we should be hesitant in simple extrapolation of gaming into the future, what kind of central bank forecasts would you like to see? Are we doing a better job now with transparency, or is there a different path that we need to take?
Well, I think that each central bank and each board of governors of central banks have different preferences. I prefer to do less, largely because I think that forecasting is, one, extremely difficult and very often wrong, and that we should only be forecasting what we know with a reasonable degree of certainty about how the current imbalances will unwind. That is extraordinarily difficult under any circumstances, but to try to go very much beyond, say, 6 months, I think, is getting in the realm of guessing.
Let's bring up chart number 7, if you would, Elaine, here. The idea here of the job economy and this election economy. It's an anxious America. And we can talk all day about monetary policy and Keynes and the behavioralists. This chart down here, Chairman, shows the U6 rate. There's the unemployment rate. There's the one you followed so much, the augmented unemployment rate. And this is the all-in unemployment rate. It's improved. President Evans looking for a glide path to 7% and to keep accommodation on. What would you say to the America that needs jobs now? What do you say in the short term that we need to do to bring the unemployment rate down?
I would say allow markets to heal. I mean, markets have been consistently bombarded with all sorts of policy decisions, which is, in my judgment, have very clearly prevented markets from adjusting. And the inability to accept any type of pain means that when the pain comes, it's going to be very severe.
Is that pain a real or even headline wage decline? If we have so many Americans that need jobs, are we setting ourselves up for a Britain that we remember in our history of an actual wage decline?
Well, what's wrong in the economy right now is that a very important segment of the economy, which we take for granted, which is building. Buildings, by their nature, are very long-lived assets. Because of the risks that are perceived in the future, because it's very difficult now with the types of policies we're seeing for corporations or even households to make long-term forecasts, and so they have pulled back. We have lost 3 or 4% of our GDP at the moment, almost permanently, basically because nobody is investing in those long-term assets. Long-term assets basically take up maybe 8% of the GDP. They're now down 50%.
We have to leave it there.